Hi, welcome to the review of Chapter 21 for the final exam. So looking at the summary sheet of the important things to know about and remember for Chapter 21. First, understand the flow of how budgets are developed, the starting point and onward. And we looked at the operating budgets and the financial budgets under the master budget. The sales, of course, are the sales forecast, of course, is the starting point. Excuse me. Next, know the benefits of budgeting and what makes for effective budgeting. And finally, understand how to compute various budget amounts with the information and assumptions given. And that's what we're about to do. And looking at this comprehensive do-it exercise on pages 1108 and 1109, I felt was a good way to review a lot of the different budget type information that we went through during this chapter. So it's broken into three parts, and in part A, what they wanted us to do was to determine the budgeted cost of goods sold. So we need to realize the ingredients that go into the cost of goods sold, that being, of course, the materials that were used, the direct labor that was used, and the manufacturing overhead that was used. Now, in doing this, with the information given, we first of all need to determine the cost of the materials used. Now, we were given a beginning inventory of materials of $10,000. Well, where was that located? That was in the balance sheet for December 31st of the previous year. Now, in the listed information at the beginning of the problem, we're given that the ending inventory of materials is $15,000. We were also given that $145,000 worth of materials was purchased during the year. So we need to know what to do with that information in order to get that portion of cost of goods sold, the cost of materials used, and that's going to consist of the beginning inventory plus the purchases minus the ending inventory. So we take the 10,000 plus the 145 of purchases minus the 15 of ending inventory, and we get 140,000 of materials used. So that's just one portion of the cost of goods sold. We have to take those direct materials used, and to that add the direct labor and the manufacturing overhead. So the direct labor was the 40,000 that was given to us. The manufacturing overhead of 73,000 was also given to us. So when we add those three figures together, we get a cost of goods sold of $253,000. Now, in Part B, they ask us for the budgeted income statement, and of course my handwritten job here isn't anywhere near as good as the formatted one in the book. But so you know, obviously when you do an income statement, you should have learned from the your introductory financial accounting class. You always head it up with the appropriate information about the company name, what type of financial statement it is, and the period that it covers, or the as of in terms of a balance sheet. But anyway, all that nicety aside, here are the key figures. And again, the sales were given to us as $300,000. We just computed the cost of goods sold above as $253,000. That gives us a gross profit of $47,000. And remember here the difference between gross profit and contribution margin. Contribution margin is sales minus all variable costs, whereas gross profit is sales minus cost of goods sold, which may and usually does include some fixed costs. Then we subtract the selling and administrative expenses of $36,000, the interest expense of $1,000. These were all given to us, and so that's $37,000. We subtract that from the gross profit, and we get income before taxes of $10,000. And our income tax rate was given as 30%. So we subtract 30% of 10, which is $3,000, to get a net income of $7,000. So hopefully everyone follows that part. Now, the next part was to put together, with that information, a budgeted balance sheet. And again, you can see this information in the text. I've just written it out here so I can explain it on the video here, going through the steps one by one. Now, the asset section starts with cash, and our ending of the year balance as of December 31st of 2014 is $17,500 based on the calculations down below here by the star, which consists of the beginning balance of cash, which was taken from the balance sheet that was provided for the previous year, December 13th of 2013. Then we add the collections, and an important piece of the information there was that the accounts receivable would only amount to 4% of the sales. We knew the sales was $300,000, so our accounts receivable, as shown above here, is $12,000 based on that formula, 300,000 times 4%. Now the flip side of that is that we collected 96% of that 300,000, so our collections are 288,000, 300,000 times 96% or 0.96. So our total available cash, the sum of the beginning balance and the collections, is 308,000. And again, I apologize for the reflecting light here that's making this a little harder to read than it should be. Then we subtract the disbursements, and we've got, first of all, direct materials. And here it's important to remember that 50% of the beginning balance was dispersed, but 50% of it was still payable. The same with the ending inventory. We can assume that the amount purchased during the year of 145 grand was all dispersed during the year. So we got 50% of the beginning inventory of 10,000 plus the purchased amount of 145 minus 50% of the ending inventory of 15,000, or 7.5 I'm showing here, which is really 7,500. That gives us a direct material disbursement amount of 142,500. The direct labor, it was assumed that the labor and overhead and selling and admin expenses were all dispersed in total during the year. That's a reasonable assumption. Note that the manufacturing overhead of 70,000 takes out that 3,000 of depreciation that was included, because the depreciation again is a non-cash expense. The same with selling and admin. It was 36,000 as given, but where you have to subtract the 1,000 depreciation because it's a non-cash expense. So we only disperse 35,000 of that. So when we add all those disbursements together, we get 287,500, and when we subtract that from the 308,000 cash available up above, we get an excess of collections over disbursements of 20,500, but we're not done yet. We need to then subtract the financing things that went on during the year, which was the payment of interest and the payment of principal, and we paid I believe 1,000 of interest and 2,000 of principal, which gave us a total financing disbursement of $3,000. So we have to subtract that from our 20,500 to get an ending cash balance of 17,500. So that's how all that came about. So we go back up to our assets section. We've got the cash of 17,500. We got the accounts receivable of 12 based on 300,000 times 4%. We got the raw materials inventory of 15,000, which was given. We got the equipment of 40,000, which was given. That's an asset balance that carries over from the previous year, less the accumulated depreciation, which is now 8,000. It was 4,000 at the end of the previous year. We know from the information given that there was a total of 4,000 additional depreciation charged during the year, 3,000 of it in overhead and 1,000 in selling and admin. So we have to subtract 8,000 now of accumulated depreciation to get 32,000 net fixed assets, which we add to the above items, cash, accounts receivable, in materials inventory to get $76,500. That's our total assets. Now, the last piece is the liabilities and stockholders' equity. So our accounts payable of $7,500 is simply 50% of the $15,000 ending balance of materials inventory. Remember, we're going to pay 50% up front and the remaining 50% in the next period. We had income tax payable of $3,000. That was given as 30% of the income before taxes. The dividends were declared but not paid during 2014. That was given to us also, so we have dividends payable of $2,000. And we have a note payable that is now $20,000. Notice that that's computed by looking at the $22,000 balance in notes payable of the previous year and realizing that we paid down $2,000 of principal during 2014. So we have to adjust that to $20,000. That gives us total liabilities of $32,500. We add the common stock, the retained earnings, and we get $44,000 more. That gives us total liabilities and stockholders' equity of $76,500, which equals total assets. So we know that we're okay there. How did we get the retained earnings amount? We had to go back to the beginning retained earnings balance, which was the ending balance in 2013 of $14,000. We had to add this year's net income of $7,000. We had to subtract the dividends, if you remember from financial accounting, and that gives us our balance of $19,000 that we used up above. All right, so hopefully that gives you a better understanding of how to get these amounts for the various budgets.